What are the tools of Federal Reserve System? According to Fed's original charter, its primary duties were to supervise banking system and to manage both the currency and commercial papers. The duties of the Federal Reserve System evolved, however, along with the predominant philosophy of monetary policy. The policy includes an emphasis on the broad economic goals as discussed earlier, especially growth and stability. The Fed's role in controlling national money supply stems from its role in setting policies to help reach these goals. To control the money supply, the Federal Reserve System uses four primary tools: the reserve requirements, discount rate controls, open market operations, and selective credit controls. These are the four options. Let's talk about all of them one by one. Reserve requirements. The reserve requirement is the percentage of deposits that a bank must hold in cash on deposit with Federal Reserve Bank. High requirements mean that the bank have less money to lend. Thus, a high reserve requirement reduces the money supply. Conversely, low requirement permit the supply to expand because the Federal Reserve System sets requirement for all depository institutions. It can adjust them to make changes to overall supply of money in the economy. Discount rate control. As the bankers bank, the Federal loans money to the bank. The interest rate on these loans is known as discount rate. The Feds want to reduce the monetary money supply. It increases the discount rate, making it more expensive for banks to borrow money and less attractive for them to loan the money. Conversely, low rate encourage borrowing and lending and expand the money supply. The Fed used a series of discount rates decreases from 6.0% beginning in May 2000 down to historic lows approaching 1% throughout year 2003 to speed up the sagging of the US economy. Open market operations. The third instrument for monetary control is the probability, the Fed's most important tool. Open market operations reserves to Federal Reserve System's idea of purchasing securities, usually US Treasury notes and bonds, in the open market. Open market operations are particularly effective because they are very quickly and predictably on the money supply. How so? The Fed buys securities from dealers because the dealer's bank account is credited for the transactions. It banks has more money to lend. And so the transaction expands the money and there becomes the money monopoly. The opposite happens when the Federal Reserve System calls and sells securities. Selective credit controls. The Federal Reserve System can exert considerable influence over business activity by exercising selective credit controls. The Fed may specially require for consumer stock purchases as well as credit rules to other consumer purchases. As we see it over here, that the investors can set up credit accounts with the stockbrokers to buy stocks and bond. A margin requirement by the Fed stipulation amount of credit to the broker can also extend to the customer. Well, within a stipulated limits, as we talk about them, within the stipulated limits, the Federal Reserve System is also permitted to specify the conditions of certain credit purchases. This authority extends to such conditions as allowable down payment percentages for appliances purchases and repayment periods on automobiles loan. The Federal Reserve System has chosen not to use these powers in the recent years.